Thanks everybody for coming. We'll get started because I know people have places they have to go. Bart Naylor is with Public Citizen in Washington, D.C. He is an old friend of mine.
A young friend.
He's a young friend of mine. He has come to talk to us about the state of the financial system and what has happened, what may be happening, and hopefully some things that we here in Montana can do about it. That's it.
Thank you, Susie. Thank you all. So I'm going to talk about banking, which I can imagine is a subject similar to root canal surgery. So I will try to make this. I intend to talk for 5, 10, or 15 minutes, and then I'm hoping we can engage in a discussion. Much of what I'm going to talk about is finance, and I actually hope to talk about actual, balance sheets and so forth. But overlaying this is politics, and we need to understand really what politics are. It has a Greek root. Poly means many, and ticks are blood-sucking insects. I work for Public Citizen, founded 41 years ago by Ralph Nader, with the theory that corporate America has plenty of representation in Washington, but what about actual consumers? What about citizens? So he founded that and a whole bunch of sister organizations that you may have heard of, Public Interest Research Group, PIRG, and so forth. And essentially, we ask just basic, simple questions in this fog of intentional complexity that corporate America wants us to misunderstand the world. Like, why should this cost so much, or why do my cars, why does the bumper cost more to fix when I run into something? He wrote a book famously called Unsafe at Any Speed. A Harvard law professor named Elizabeth Warren, viewing this profusion of financial products in the 2005, wrote an article questioning why there should be all these financial products, and in homage to Ralph Nader, titled her piece "Unsafe at Any Rate." That idea became the kernel of the Title 10 of Dodd-Frank Wall Street reform. We now have the Consumer Financial Protection Bureau, thanks to her asking those simple questions. We are at an important point in financial history. 80 years ago, Congress in 1933 responded to the crash of 1929 with a deal. You might say, well, if the crash was in 29, why did they wait till 1933? And I'm pausing here because Congress was the wrong one. It took a Democratic Congress and a Democratic president to do what I would call the right thing. The Republican-controlled White House and Congress was not ready to do that. And save that. That's going to be pivotal to what's happening here and why Montana is important. The deal was this. Savers, you are frightened of putting your money into banks because they seem to do silly things like blow themselves up. So we're going to guarantee when you put your money in a bank that you can get it out, at least up to a certain amount. But banks, you're now going to get money from people, which are in effect loans, and they're not going to care anything about how well you manage the bank. Imagine that. If you loan money to anybody or anything, you're going to ask a fundamental question: are you going to pay me back? Can I have a little collateral? You don't have to do that for a bank. Well, look at it from the bank's point of view. I'm getting in federally guaranteed money, and I don't have to prove to the person lending me money that I can even repay it, because if I blow up, the taxpayers will pay it. We have socialized insurance for two segments of society. For older and poor people with health problems. It's called Medicare and Medicaid. And for bankers. And let me tell you, there are a lot of people that don't think we should have socialized insurance for poor people and older people, or at least, you know, we've had this Affordable Care Act, Obamacare. But so why shouldn't we be really stingy about what the banks do with the taxpayer-backed loans that we are giving them? 1933, they did put some tight strings on it. I hope you'll remember these two names, Glass-Steagall. It's called the Glass-Steagall Act. More formally, it's the Banking Act of 1933. And they said, okay, banks, we're going to guarantee your liabilities. We're going to socialize your debt. But we don't want you gambling. We want you to take that money and do something pretty boring. We want you to make loans to businesses, loans to people to buy a 30-year mortgage. And okay, what you should do is what's called the 363 banking. You take in deposits and you pay those guys 3%. You lend it out for 6%, and you hit the golf course at 3 o'clock. That worked fine for 30, 40 years. Investment banking is the risky stuff. That's the underwriting of stock, that's the buying and selling of stock, and since then it's become far more complex with words that you're intended not to understand, like credit default swap and collateralized debt obligation. There'll be a quiz, by the way. The banks divided into two. The commercial bank of J.P. Morgan became J.P. Morgan. The risky bank became Morgan Stanley. Bank of Boston became Bank of Boston and First Boston Securities, and so forth. Nobody was buying stocks anyway. Everybody got burned in 1929. But 30, 40 years later, the investment banking became attractive, and the banks wanted back in. They wanted to do something more fun than making boring loans to businesses, and golfing was getting a little tiresome at 3 o'clock. So through regulatory fiat in the 1980s, through the controller of the currency, and then in 1999 through a wholesale repeal of Glass-Steagall, the bill is called Gramm-Leach-Bliley, banks were let back into the risky stuff. And it wasn't but 7 or 8 short years later that they blew up the world economy. As you all recall, on September 15th, Lehman Brothers was not bailed out as Bear Stearns was 5 months before. And Lehman Brothers was not a commercial bank, but if you read its shareholder report, their turf was being invaded by the socially insured liability balance sheet banks. J.P. Morgan was storming into their field. They felt they had to get big real fast. Their liabilities, their debt in between 06 and 07 grew by 40%. Nobody's supposed to get that big that fast. And what they were doing, what proved fatal, is they were taking a whole bunch of mortgages. I told you there's going to be a test. I'm going to explain. I'm going to see if I can explain a CDO, a collateralized debt obligation. They took all these mortgages, and they wanted mortgages and more mortgages and more mortgages, and if nobody could afford to buy a house, just give them a mortgage anyway, and if they didn't have any income, just make it up, you know, just write an extra zero on their income. Because they had this magic thing called a CDO. A CDO, imagine a pyramid of champagne glasses. And you start pouring the champagne in the top glass. Those are the interest payments from the mortgages, and it will fill up. And then it will spill over to the next 2, and then the next 4, and then the next 8, and so forth. Those are called tranches, and they are then sold to investors. Now, if you buy the top tranche, so that's what they were doing. These are mortgage-backed securities. There are just thousands of mortgages. And they thought, well, this is wonderful. We really don't even need to know how well they will repay, because we'll just sell the top champagne glass to somebody, and he'll have to pay more for that because it's the safest. There's going to be something coming out, and we'll be charging a little less for the next tranche, and then the bottom tranche, well, you know, we'll give it away. Except they couldn't give it away. Lehman Brothers was sunk because it still had the bottom tranche. It couldn't find anybody stupid enough to buy it. There were some people stupid enough to buy it. The nation is called Iceland. And Iceland went bankrupt buying the bottom tranche. Zions Bank was complaining about the Volcker Rule yesterday. That's a Salt Lake bank, because they have all these bottom tranches of CDOs, and the Volcker Rule makes them mark it to market. That is to say, they claim we're going to hold it to maturity. These mortgages will eventually get repaid, so we're not going to actually say what the fair value is if we had to sell it today. But now the Volcker Rule makes it, and so lo and behold, they record a $350 million loss. Well, if you're sitting on an empty house, I mean, it may sell in 10 years, but right now the market value is something, and we all should know that. The financial crash from the Lehman bankruptcy first caused a run on a money market mutual fund called Reserve Primary. Who has a money market mutual fund? It's almost as safe, you think, as a checking account, except it actually pays a little bit of interest. But what if it didn't? Well, you would find another money market mutual fund. Well, Reserve Primary was one of the biggest money market mutual funds, and it decided not to pay interest. Technically, it was called breaking the buck. So everybody took their money out of Reserve Primary. Well, Reserve Primary was using your money to make short-term loans for factories and so forth. It's a short-term credit market. So suddenly, not only did people take it out of Reserve Primary, they took it out of all the mutual funds, and so all the money market mutual funds didn't have money for these short-term loans to factories. And suddenly we had a short-term liquidity crisis, and suddenly, well, not so suddenly, after a few months, people got laid off because the factory couldn't meet payroll, et cetera. Lo and behold, we found out those people could not actually pay their mortgages. They were kicked out of their homes. 5 million people have, and so forth. We have a $12 trillion financial crash that we are living with today, and it's going to take us a long time to dig out of it. Congress did respond in 2010 with the Dodd-Frank Wall Street Reform Act. A Dodd is not a bird, and Frank is not an expression on one's face. Glass-Steagall, Carter Glass was the senator from the state of Virginia who was the brains behind the Banking Act, and since this has to go through the House, they also stuck on the name of the House Banking Committee Chairman Henry Steagall. Dodd is a senator from the insurance state of Connecticut, and Barney Frank was a senior congressman from Massachusetts and chairman of the House Banking Committee. I'm pausing here because people's egos and names and where they are in the House and the Senate has way too much influence. But I'm coming to a punchline pretty soon. It involves politics, and you know what politics are, right? The Dodd-Frank Wall Street Reform Act has 400 rules embedded in it. These are the actual changes, new rules that banks have to oblige. One of them is the Volcker Rule. Show of hands, who has heard of the Volcker Rule? Wow. Who wants to tell me in a few sentences? So the Volcker Rule says when you take in this money, don't gamble, but unfortunately, this will be a shock. Hold on to the desks in front of you. Not all laws are passed soberly and by smart people that just have the best ideas in mind. They are passed with compromises to get a vote from this guy and get a vote from that guy. Well, they didn't kick the banks entirely out of the risky stuff. They allowed them to continue to do market making. Market making benignly means finding a buyer and a seller and matching them and popping a commission out of that. You can do it by brokering, where you don't ever buy the thing yourself. I just take your stock, literally give it to her, take my commission out. Or I could do it by dealing. I will buy your stock, and then I will sell it to you. And funny things can happen between when I buy it from you and when I sell it to you. The price can change, and that can be really cool. That's called proprietary trading, where I am making some money out of this, and I'm the smartest guy on the planet. At JP Morgan, if you look at their credentials, I'm mentioning them because it's the largest bank on the planet, $4 trillion in assets. 4 trillion, how much is that? That's a lot. My daughter taught me this, because a trillion is different than a billion. Start counting 1 Montana, 2 Montana, and it will take you 1,000,000 seconds. If you did it 1,000,000 times, it would take you about 2 weeks. You have to do that 24 hours a day. That's 2 weeks. If you counted 1 Montana, 2 Montana 1 billion times, it would take you 30 years. So 1 billion is a lot bigger than 1,000,000. But a trillion, it would take you 30,000 years. And so that is really a long time. 30,000 years, humanity did not know how to farm. So JP Morgan has $4 trillion in assets. They and the other big banks, of which there are 3 or 4, and they control half of all our deposits. There's $10 trillion in deposits in between Wells Fargo, Bank of America, Citi, JP Morgan. They've got 5 of those billion. Trillion, sorry. No, trillion, God, which one? Yeah, trillion. It's a lot. What does JP Morgan do with its $1.3 trillion in deposits? What should it do? What do we want it to do? Invest in education. Yeah, makes loans. Well, it does have $800 billion in loans, but it also has $300 or $400 billion with which it plays games. A lot of it is in London. In the year 2011, that London office did really well on a bet. Now, you think I'm being cavalier with this phrase, bet. They bet people on the other side of the bet. I'm Episcopalian, and we invented euphemisms. Those people you bet with are called counterparties. Their counterparties were other banks. Morgan Stanley was their biggest counterparty. They bet Morgan Stanley that American Airlines would go bankrupt, and they won. I'm pausing there because why is that a good use of your taxpayer-backed deposits? American Airlines went bankrupt? Well, I guess it's a good bet because they did, and they made a lot of money. And their traders got bonuses. Bruno Isco, Ina Drew got $10 million a year. These people are about 30 years old. They got $10 million because they made an excellent bet. Well, the next year, they didn't do so well. And it was announced, actually revealed in the press, because some of their counterparties were having trouble making sense of this one bet. All the bets are anonymous. It's like poker. You do not want to tell people who you are. But there was this one player in this betting market. It's called a CDX. Do you remember CDX IG? It's just betting. Was really big, and the price wasn't acting normally. And they all found out. It was this one trading desk in Canary Wharf of London. Who's been to London in the last 5 years? There's this old dock area that has been renovated with all these beautiful high-rises. Manhattan has now been recreated in London, and it's the trading place of choice. Those guys aren't necessarily English. The trading desk of JP Morgan was heavy French and Spanish guys. Fabulous Fabrice Touré, the guy at Goldman Sachs, is French. I mean, these are not Americans gone over there. They're just the best and brightest kids with math degrees usually that they can find, and they're being paid $10 million a year to make these bets. They lost $6 billion. The shorthand is the London whale. That's not only a violation of the Volcker Rule, which is now in force. The Senate Subcommittee on Permanent Investigations found fraud all over the place. They were cheating and lying to disguise the loss. I can go into some detail. It's a gory story. I don't know why anybody reads fantasy or fiction, because banking is so much more unbelievably sordid. Oh, there's sex too. I mean, the Wall Street Journal used to be better, but it's still. I mean, I don't think you ever need to read a fantasy novel ever again. The Volcker Rule still permits market making, and a lot of games can get played. So there is an answer. Let's just get the banks out of market making altogether. A senator from the same person that conceived and ushered the Consumer Financial Protection Bureau into law, which is really the best part of the Dodd-Frank Wall Street Reform Act, was supposed to be head of it, but Wall Street really hates Elizabeth Warren. I can't tell you how, just one small, well, there's so many examples of how they hate her. They can't even say her name. I've been to speeches like they just, and that senator from Massachusetts, they just can't say the name. So the problem with Democrats and Wall Street is it's one of the few sources of money for Democrats. Republicans are pro-business, and corporate America likes Republicans generally. Wall Street wants to give money to anybody in power, and often Democrats get in power, so you give money to Democrats. And Obama, the Obama machine, the Clinton machine, needs to have a very close relationship to Wall Street. You see it all over the place. You see who the appointees are once the president, Obama named Timothy Geithner to be Treasury Secretary. He named Gary Gensler of Goldman Sachs to be the head of the CFTC. Gensler was going to be Treasury Secretary if Clinton had won. Gensler surprised everybody by being a good regulator. Geithner surprised nobody by being one of the world's worst Treasury Secretaries. Obama really wanted to name his friend Larry Summers to be the chairman of the Federal Reserve Board. Larry Summers, he even gives arrogance a bad name. Larry Summers was young Harvard professor, economist for the IMF, became a Treasury Secretary under Clinton and advised that Glass-Steagall be shattered, and it was. Uncontrite about that. Followed up that success by becoming the first president of Harvard ever essentially fired for such famous remarks as, the reason there aren't that many female math professors is that women just aren't good at math class. I'm not making this up. I'm not making this up. And for months, we complained about Obama thinking about Larry Summers. He wasn't making it a secret. He was saying, he's on my short list. And lots of press activity show it. I was quoted, other people were quoted saying, why would you trust the Federal Reserve with the guy who designed the financial crash of 2008? But still the president pursued it. There were some senators that finally came out against him, the likely ones, the liberals, Elizabeth Warren. And then there was this funny guy from Montana, a moderate, on a Friday in August who said, I don't think I can support Larry Summers. I was surprised, and I've tried to reconstruct why that happened. Maybe some of you in the room know. I do know that I was the head of investigation for the Senate Banking Committee, and I was succeeded by a Montanan named Bart Naylor. I don't know if you know that name. Apparently his father or grandfather was a long-serving state senator or something like that. He actually, before he got the job I had at Senate Banking, worked for the Federal Home Loan Bank San Francisco, which actually were the ones closing down savings and loan. And he personally closed down Lincoln Savings and Loan the most notorious of the rogue thrifts, headed by Charles Keating, a truly demented man who was an anti-pornographer, but nevertheless had a warehouse full of pornography, presumably to study the problem in detail. So DeZevia also had several conversations with Mr. Tester and some of his staff, and Tester came out, that was it. If I'm going to lose moderates, the president must have calculated, I am going to withdraw. Why am I dwelling on that? I think your senator, who I see possibly as much as you do, though there is a dais between me and him because he's interrogating witnesses. This is a battle for his soul, because as Glass-Steagall goes from a great idea to a political possibility, it requires moderate support. We all saw that some relatively few people can make a big difference in Washington. 45 Tea Party congressmen decided to make a point that health care shouldn't be, poor people shouldn't have health care subsidized by taxpayers. And because our Constitution requires, the House and the Senate to agree, and because John Boehner wanted to remain Speaker and he needed those 45 Tea Party supporters, they closed the national government for 16 days. The Glass-Steagall bill needs to go through the Senate Banking Committee, which means it needs a majority support. There are one or more Republicans who may well support it, including the most senior Republican, Richard Shelby. He's not ranking. He actually was the chairman. They have the Republican Party rotates that. So the ranking Republican is actually Mike Crapo at the state next door. So then you look at the Democratic side. It already, of course, has Elizabeth Warren, who's on the committee as a co-sponsor. It will get liberals, Sherrod Brown, Jeff Merkley of Oregon, and so forth. And then there are these moderates, the most senior of which is John Tester. I have personally spoken to another moderate from West Virginia, and he told me point blank, if we get Tester, we've got Manchin. And then once you have people like Manchin, and Heidi Heitkamp is presumably similar, this bill goes from an idea to a possibility, and then I don't think anything like this can get through the House until the Tea Party understands the subsidy part. I don't want to get us too far afield, but there's this thing called the Koch Brothers. The Koch brothers make their money on a lot of things, but one of them is this swaps business. This same little shenanigans in banking. Now, they themselves are not banks, but they enjoy the counterparties. They enjoy the publicly subsidized swaps arena. So I don't really know if the Tea Party members understand this very well. I'm going to try to see if they do. But I think the pivot is Tester. Noting that a Democrat and a seat costs many millions of dollars has a source of funding from Wall Street, I think your standard Democrat is making his or her decisions based on, I'd like to do what Wall Street wants because it's lucrative, unless it will harm my constituencies, and my constituents tell me that. Now, I appreciate banking, not unlike dental work, is not that much fun necessarily, but I tell you, it can be really juicy. But I think if he hears from his constituents, he will take this more seriously. This is the guy that stopped Larry Summers from being the Federal Reserve Chairman. There's something that I think is very progressive in his thinking. He didn't have to do that on Larry Summers. And I would appeal to you as people that have far more clout than you can imagine, because this is a small state. I assume most of you know him or have spoken to him. And he will listen to you. Your voice will be far louder than a Wall Street voice, because in the end, you're the ones that determine whether he he is your senator or not. As Susie mentioned, there's a piece of paper that can express that view. I urge you to chat with him. And let me stop now and invite you to challenge, to ask for refinements, questions, go over what politics means again.
You said that there is the subsidy of what the Tea Party might go for. Explain that, would you?
Well, if the Tea Party is all about subsidies and being against subsidies, this is one of the biggest subsidies that are. Not only is FDI effectively a subsidy to the bank, because you're not getting 5% interest when you loan your money to your bank. And you don't demand it because there's this wonderful thing. If the bank dies, you get your money back, which is not true if you buy the bonds of American Airlines. You don't get your money back. You don't get it all back. And yet American Airlines is a big company, but its liabilities are not socialized, but every bank is. And something's worse. A community bank is at a disadvantage to a big bank because a big bank is too big to fail, too big to close. Bank of America, Citicorp, they were all bust just like Lehman Brothers. But we bailed them out. And what that really means is we made their bondholders whole. Not the stockholders, they lost a lot. But if you had a bond in Citicorp, it's good. We guarantee, that's not FDIC insurance, that's the bailout. That's TARP, that's the bailout. The Fed also has this thing called the discount window. We can go into that if you like. So the too big to fail banks actually borrow money from the bond market and short-term credit markets cheaper than the bank that's on the other side of this building, the community bank. They have a funding advantage, which of course they can then compete against that community bank. There's no big secret as to why 5 banks control 50% of American banking when whatever it was 10, 30 years ago, it wasn't nearly as concentrated. Is that helpful? Yes.
Any chance that we'll get common sense bills like this one that we're signing on to today passed in a Congress that is overwhelmed by fraud and by money in elections, and and the need to pay back in terms of their actions to the people who gave them that money?
You raised the central question, and that's why the chance rests with Montanans. I next go to Idaho, where I'm from, to try to make the same pitch. But there are certain people that have inordinate influence. I taught math in England for a year, and I found myself at a fancy dinner in Oxford, sitting next to this stately gentleman who I found out worked for the Oxford English Dictionary, and I asked him, I've always wondered, who decides how to pronounce words? And he paused and he said, I do. My freshman roommate at college was his name was Mark Roosevelt, and he was very shy. It took him almost 3 seconds to tell you that his grandfather, great-grandfather, was Teddy Roosevelt. His father, Kermit Roosevelt, chased Mohammad Mossadegh across the rooftops of Tehran in 1953, putting the Shah in power. There are some people that can do stuff. And now that one didn't work out so well for us. Iran kind of holds that against us to this day. I have some issues with how words are pronounced, and I can't. That guy is gone. But you guys, in a state with less than 1 million people, who all of you, just 1 million. I don't see. I'm from the big state of Idaho. We have well over 1 million people. You have a lot of influence, and Tester has a lot of influence. And your question is precisely the one that we progressives are trying to get through. Money, Wall Street in particular, has a firm grip on Washington. But I think that we are in the realm of possibility. I'm not saying this is going to pass, but I'm saying with your efforts, and I'm not asking for a lot of effort, I think it's possible. Yes?
So in 25 words or less, what exactly does this 21st century Glass-Steagall bill do?
It gets banks out of all the risky stuff. No swaps, no market making. They can just make commercial loans, mortgages, and so forth.
So it doesn't keep them small.
It does not do that, although it does have a size limit on how many assets. But you're right. If I was tyrant, and I really should be, by the way, I don't know why people have the right to vote that don't vote the way I do, but yes, we should cut the banks down, you know. JP Morgan should not be $4 trillion. It shouldn't own Washington Mutual and Bear Stearns. Find somebody else to own those enterprises. It shouldn't own Chase. It's way too big. There's another bill that is possible that asks banks to put more of their own money, that is to say shareholder money, into any given deal. They demand you put 20% down when you buy a home. Banks only put 3 or 4% of their own money. So the $4 trillion of assets that JP Morgan has, assets are loans or deals, swap bets really, is what most of it is. It actually only has $200 billion of its own money, $186 billion. When it lost $6 billion on the London whale, you know, it just got roughly 3% poorer just with that one bad bet. So we should cut the banks down to size, make them put more of their own money, such that, you know, that's more money for them to run through before they come to us. And let's restrict their activities to the safe things. That's the Glass-Steagall bill. By the way, it's not only sponsored by Elizabeth Warren, but Republican John McCain, who, see, I'm from Idaho, so we're so proud of Sarah Palin, who is from Sandpoint. And so I like to conservatives say, this bill is sponsored by Sarah Palin's running mate. That's my big Tea Party. John McCain, Maria Cantwell, who is from 2 states over, state of Washington, and then the standard liberals, Bernie Sanders, et cetera. But we need moderates. We need John Tester on this bill. Yeah.
What's the date
Oh,
of the
sorry.
bill?
The 21st Century Glass-Steagall Bill, S-1282. But if you say Glass-Steagall, what was Glass's first name? Carter. Good, good. Yeah, just let me come back.
A couple of quick questions. One is, you talked about the money market accounts. The Central Labor Council has a scholarship fund in a money market account with a Montana brokerage company. Do you advise getting the hell out through a credit union or something? Or?
I can answer that question
Yes.
because I'm local.
Yes.
The answer is that it depends on what the bank or institution is where you hold it. Some have contracted to have FDIC insurance on their money market accounts if they clear through Wells Fargo or some of the big banks, but that is not across the board. So ask them specifically that question.
Okay.
And if they do not FDIC insure their money market, then ask them to put it in the U.S. Treasury money market, where they are restricted to only purchasing Treasury securities which are backed by the U.S. government. Okay?
The second part of my question is, Tom Hartman's got a book out now called, you know, we've been reading The Coming Crash of every year ever since I can remember, but he's saying in 2016, and his rationale is that each administration, as it comes toward the end, has to keep propping up the economy to try to get through the next one. And when this administration is done, everything's going to fall. Does that make any sense to you?
It makes sense. Do I think that's going to happen? No, personally. But fortunately, I'm not paid to make such forecasts. But you know, the financial system is not secure. It should be secure. We have a serious problem in America that we are becoming a nation of moneylenders. In 1980, we spent 18% of our dollar on food. Now it's 14%. We've gotten better at making food. Okay, factory farms, we can have issues with that, but it's cheaper. Healthcare has risen, and banking has doubled. In 1980, it was 4% of our dollar. Now it's 8%. Now, banking is not something you eat. Healthcare you do consume. Well, ideally you don't consume it, but we do actually get sick, go to the doctor. Banking is something that's supposed to be invisible. It's an intermediary. I used to work for the Teamsters, and if I was to say trucking went from 5% of the economy to 10%, you'd say, whoa, are those truck drivers getting lost? You know, things should be ever more efficient. This thing has more computing power than the Apollo, whatever, 13 that landed us on the moon, and it costs $650, whereas Apollo 13 computers cost more than that. And yet banking is taking up 8%. Well, because they figured out more ways to get our money, to take more money out of our money. They call that, by the way, innovation. Yes?
What's the timeline on
The bill?
process that's coming that you're engaged in?
We're playing the long game here. We're in the 113th Congress. We've got 14 or 13 more months of it. The bill was introduced. All bills are introduced into a Congress. All Congresses last 2 years. This is short of a big scandal. This bill is unlikely to get a vote in the Senate, let alone the House, in the 113th. What has to happen is a good Congress has to get elected in the 114th. Senator Tester will be in the 114th. There has to be some changes in the House. And then Senator Tester becomes actually all the more important because he will rise a notch. There are a number of senators, including the chair of that committee, Tim Johnson of Dakota, who is retiring. So he will go from pretty important to pretty much a lot more important. Max Baucus will retire. You've got another 13 months to get good tax reform, and that guy is the single most powerful person on taxes in the Washington right now.
Is there a chance?
Say again?
Is there a chance?
Yeah, there's always a chance. I was 100% sure the Republicans were not going to close the government, so you can see how good a forecaster I am. Yes, you had another. Yeah.
You said that we're $12 trillion in the hole?
The economy, this is an estimate of the General Government Accountability Office. What is the hole? This is, if you have an economy and you forecast it to grow or be something the next year and 5 years out. Then you have an event that causes your projection to change. So we are $12 trillion below where we would have been. What is $12 trillion? Well, that's one of those big numbers. The U.S. economy is a little bit bigger than that a year. We wiped out a whole year of U.S. economy. And it's a magic thing called the present value of dollars. This is forever. A dollar today is more important than a dollar tomorrow, and far more important than a dollar in 1,000 years. That dollar doesn't even appear when you're making forecasts. So $12 trillion less than what we would have had.
However, the Fannie Mae and Freddie Mac had $6 trillion worth of the American people's mortgage money. And it seems, and that's not an extrapolation or that's not an iffy anything, that would be pretty solid. And somehow or other, it all links up together as far as the housing market being the backbone of the economy. Something really fouled up in that government-regulated whole thing, including HUD.
Well, I would say the single biggest problem with Fannie and Freddie is that they themselves had very low capital requirements. Capital in this case is the amount of money that Fannie had to have in any given deal. And because it was government-backed, they were down to about 1%. I told you that J.P. Morgan is about 4%. How much of Fannie's own money is in the stuff it owns? Mostly, the stuff it owns is based on borrowed money. Just the way when you own your house, you owe money to the bank. That's what owning your house means. Well, when Fannie owns those $6 trillion, it owes money to its creditors, and it only has 1 or 2% of its own money. And you all watch your house price very carefully. Well, if you want to know how bad the financial crash was, it affected everybody. Suddenly, everybody's house price, which is most of our most valuable asset, it is our retirement savings, is that price. And the banks played a major, dealt a major blow to that price. I promised that you could leave by now, but... Yes, please.
Beyond the grassroots
Yeah.
work and networking that
Yeah.
you're doing, what's your national strategy for public relations and getting the information to the public?
Public citizen, we blog, we write, we try to appear in the media to the extent the media will hear us whine. Public citizen itself, we invite you to join. I think it's $15 a year. You will get more emails from us than you may care to. We have activists that petition. So the Volcker Rule invited public comment, as do all rules. There were 20,000 public comments. I personally wrote one of them, which was cited in the final rule 140 times. But 15,000, more than 15,000 of the 20,000 public comments were from public citizens. I mean, they were very short, you know, make a strong rule and so forth. But we're active. We are petitioning to get a constitutional amendment to essentially to overturn Citizens United, to try to establish some sense into money and politics. HSBC was admitted to money laundering violations of $200 trillion a year ago this month, and our Attorney General infamously said, yeah, that's really bad, but it's too big for me to do anything real. Too big to jail, it's known as. So we asked if the Attorney General of the United States can't deal with this, let's ask a simple question, as public citizens often do, to the state where it's incorporated. All companies are incorporated in a state. Most of them are Delaware. This one happened to be Maryland. So we petitioned the Maryland Attorney General, and 40,000 public citizens signed our petition. Yes. Do you all need to go? Should I allow you polite people? All right, one more question, but I'm happy to talk after that. Yes?
Did you say public citizen?
Yes.
You can Google it?
You can Google it, citizen.org. We have roughly 300,000 members and supporters. We are nonpartisan, but we are usually labeled as left-leaning. I have, you know, I thought I was all the way down left, but I guess I'm just left-leaning. I used to, before Public Citizen, I worked for the Teamsters. Do you know how many Teamsters it takes to change a light bulb? It takes 8. Do you have a problem with that? Thank you, Susie.
Petition. That is the first volley and the first voice that will be heard by John Tester. It is back there. Plus, we have an electronic petition that if you don't know the Montana Organizing Project, you should. It'll be on their website. Anybody whose contact information you'd like us to have to keep you informed, give it to Lauren, write it down, give her a card, any of that. We want to take and build on everybody who is here and keep this message going so that more voices are speaking to truth to power.
I have business cards for anybody who wants email or cell phone.
And thank you for coming in.
Thank you.